Great to be here. Thanks. Thanks, everyone. This is such a cool group of people who want to talk about tax. It's just it's like light relief sitting on your own in a university office for 4 or 5 years, and then you get this. It's like a giant present. So thanks a million. Great to be here, and it's because of FJI that I decided to do, and the Tax Justice Network and Christian Aid and Oxfam, that I decided to do this PhD. Partly from a campaigning point of view, because I felt like this area is complex, and I didn't understand Ireland's regime. I knew we were a problematic actor on global tax issues, but there was very little in terms of research that was rigorous, that was up to date, to guide us as campaigners on understanding Ireland's corporate tax model. So I am going to talk about the model, okay, as I kind of traced through my PhD studies, and then I'll touch a bit on campaigning for tax justice in Ireland. Thomas asked me just to reflect a little bit, though I'm very long in the tooth now out of FJI, but I will tell you a bit about what it was like way back then, like over 10 years ago. Okay, so if we go to the next slide, Thomas, just to talk through Ireland's corporate tax model, a way to start is maybe by thinking of it as this like dual entanglement of real foreign direct investment mixed in with artificial foreign direct investment, okay? So what's real foreign direct investment? I define that as jobs, real stuff, things you can see, people gaining employment, and foreign direct investment into Ireland is enormous by European standards, by the standards of the small size of the country, even in terms of the real stuff. And the vast majority of this employment is created by US multinational corporations. Secondly, the UK, but the majority share is US multinational companies. Because these jobs are so central to Ireland, and because Ireland invested so heavily, kind of put all its bets on attracting foreign investment into Ireland, this is basically Ireland's industrial policy, okay? So there isn't really a strong, robust enterprise policy for domestic companies, for example, in Ireland. So the real stuff, the US firms, they were attracted by lots of real things that have happened in Ireland, progress in our education system, English-speaking workforce, and critically, hugely important, access to US markets. And from a tax point of view, access to EU markets, did I say? Sorry. And access to EU tax rules as well. Okay, next slide. So you can see this is really real, okay? So these are all the companies that turned up in Ireland from the 1950s. And you can see Ireland was very lucky because you look there, these are the superstar firms of the global economy. So we had the early arrivals, then we had tech arriving, pharma after that, more tech, financial services from the late 80s when the Financial Services Centre opened up, another wave of tech in the 2000s, which were the digital companies. Okay, so we move on, Thomas. Thanks, Bill. So what's the artificial stuff? Okay, so I define artificial foreign investment as driven by tax and regulation avoidance. So that's what the companies are trying to do, alongside many of them also engaging in the real employment. So what's the attraction for this artificial FDI? It's Ireland's low corporate tax rate, which, you know, everybody in the country knows about. They'll tell you the corporate tax rate before they'll tell you the tax band that they're on for income tax themselves. Because of the interaction of Irish and US tax rules, and this is critical to understanding the Irish case, okay? We don't hear about German multinational companies doing loads of tax avoidance through Ireland. Okay, not saying it's never happened, but it's not a big pattern. So the sustaining of this interaction of these tax rules that really mesh together very well to support tax avoidance is through two big political imperatives. So two different kinds of tax politics. One in the US, which is driven by the brutal power of US multinational corporations. Okay, they have massive influence over elected representatives, which shut down reform initiatives by whether it's the Treasury or the IRS in the US. The Irish government, a more quiet form of power, okay, through this kind of coalition between elected government officials, our civil service, our tax administrators, and tax planners. So the big four, the people who understand all the complexity of this stuff, are in close coalition with the Irish political regime. Okay, we'll go to the next one. So, side note, there is also a real knock on effect in Ireland, a real material effect, which is as a result of the artificial stuff. Okay. And this is important to talk about because this is what makes the model profitable for Ireland. It's what makes it worthwhile um, in one part. The other part is the employment that is created by the US foreign firms and the knock-on employment that those firms also create among Irish business. But the corporation tax receipts are like mind-boggling bonanza level, totally abnormal for a small European Union state. And you can see here, this one is the kind of historic highest point, which is 2022, I think. Yep, which reached 21 billion in corporate tax receipts in 2022. Since then, I think last year the receipts were 28 billion, so it has kept going up. So that's abnormal because this is looking at Ireland's tax breakdown. Okay, how does the government collect tax revenue to fund our public services? You can see that corporation tax, the blue bit, has accelerated from a share of the total tax take of about 8% up to in 2021, 16.5%. And that's probably about like double what you'd be seeing in bigger European Union countries, for example. So this puzzles people because they go, wait a minute, if Ireland's a tax haven, why are we collecting so much tax? Because tax havens are associated with like the Bermudas and the zero corporation tax jurisdictions. But because Ireland has a low corporate tax rate, 12.5%, now 15 for some firms, it means that um, when really extensive profits are placed in Ireland by these companies, just having a low corporate tax rate makes the corporate tax receipts enormous. Okay, so that's the explanation for that. Next slide, Thomas. Thanks. So, how to find out? When I was studying, I was like, where do I freaking start? Because it was like there's stories in the media about Ireland. There's loads of kind of anecdotal stuff that we know about tax avoidance via Ireland, Liechtenstein on the Liffey, all those kind of phrases about Ireland. But I was trying to go, okay, where will I begin to look at where the big stuff is? Because corporate tax avoidance or evasion will, happen. But what I was interested in looking at was the really big kind of structural interventions that were happening around this area in Ireland. So, one of the big indicators is one that was given to us by our own government, where they admitted that the measure for Ireland's gross domestic product, the measure of what's happening in the that our statistical office uses to tell us what is the domestic economic activity in the country, is not a real indicator of real economic activity. And the reason for that is because there's so much foreign money either flowing through Ireland or coming into Ireland and staying here. So the simple sum that the Department of Finance has explained to us to work out GNI star, which is the real domestic economic activity in Ireland, involves taking away this, which is the big financial flows, so 90 billion of euros flowing into Ireland annually, what they call income from redomiciled firms. These are inversions. Okay, we'll talk about those in a minute. Um, Money relating to research and development and intellectual property, and money relating to leasing of aircraft. Okay, so that gave me a clue of going, okay, these are the big areas of finance that are coming into Ireland, but the government has indicated they have no connection with the domestic economy. Okay, so that gives us a clue. Okay, we'll go on, Thomas. So from there, then I started tracing the kind of big policy shifts in order to figure out the types of tax gains that have been happening in Ireland. So we start with the 1950s. Think of the west of Ireland, Shannon Airport, the development of an export processing zone around that area, zero corporate tax on goods, on profits from goods produced for export. Okay. The European Union is beginning to step in from the 1970s when Ireland becomes a member, is concerned about this special treatment, okay, what the EU would call, European Commission would call state aid. So Ireland kind of then bumps up the tax rate to 10%, but lets it apply to manufacturing, profits from manufacturing in the country, tangible, intangible, it didn't matter. So that was still a really low tax model. 1987, key year when the International Financial Services Centre was set up. And then you begin to see things that are coming up in the last calculation I showed you, like aircraft leasing operations, for example, in Ireland. And then in the 1990s, the profits into Ireland accelerated massively. And we see the games that then became kind of media news, yeah? So the corporate inversions, like lots of big pharma companies flipped their headquarters. Sometimes they're US companies, sometimes their headquarters were in the US or in the UK. They flipped them into Ireland for tax purposes. The double Irish, Apple statelessness, and the game we're in now, which is the onshoring of intellectual property assets. Okay. So if you look at it, like this is where we are now, we're in the last two, okay? But within those, financial services, steady as she goes. There is no real challenge to the scale of financial services or anything that's happening in financial services in Ireland. It's an area ripe for more research. The corporate locations, okay, so the ones where the double Irish and statelessness ruined Ireland's reputation all around the world, those have been closed down because of legislative changes in Irish domestic law around tax residency. The corporate inversions kind of ended because tax rules changed in the US, so the companies kind of didn't see it as beneficial as they used to, so they stopped doing it. And the onshoring of assets of intellectual property is what's happening in Ireland and what's driving. Remember that huge shift in corporate tax receipts that I showed you? It is because of the intellectual property assets in Ireland, which are onshored into Ireland. When intellectual property is here, it justifies bringing, booking your profits where your intellectual property asset is present. Even though we have a low corporate tax rate, a rule in relation to intellectual property in Ireland is that you can write off the cost of the transaction of moving the intellectual property into Ireland against your profits, which is a massive tax write down for these companies driven by intellectual property, especially tech and pharma. But the profits that are left over are then taxed at the normal rate, 12.5 or 15, and that generates these billions for Ireland. Okay, Thomas, we go to the next one. So what makes the Ireland US tax gains work? Okay. So how we think about corporate tax in general, you generally think about the tax rate, like we were talking about, what was the rate in the US, what's the average rate in the European Union, etc. But what really gives an engine to gaming tax is the reality that there are lots of other dimensions that govern corporate taxation. So there's the rate, the big thing that's public that we all know. Then there's the jurisdiction. So rules that link the taxpayer or an asset to claims made by a jurisdiction. The owner, so who owns the capital, the entity responsible, they're treated in different ways by company law in different jurisdictions, and the return. So how profits are, in what way profits or streams of income are taxable in a jurisdiction. Okay, so tax games are like really fun in that sense that you've 4 dimensions to play with in order to construct a tax game. So go to the next one. So here what I looked at, and I know you can't read this and you don't need to be able to read it, but it's just to illustrate evolution in the Irish tax games. So what I found was there's basically kind of six big types of interventions of tax gaming via Ireland. And they all had different elements of these four dimensions. Yeah. So they had different levels of importance to making the game work. So Thomas, if you go to the next slide, I've just highlighted, I hope. Yeah. Oh, is there another? There's supposed to be some highlighting that come up there. This one here. Can you see the one down there? All right. So that maybe press it again. It might come up. No. Okay. Not to worry. I'll just talk you through. Sorry about that. But the first game around Shannon Airport, the rate was the thing. Okay, and also the fact that it was, on the doorstep of the European Union. If we move to the financial sector, things that became much more important were the jurisdiction rules, but also the treatment of particular companies. Then you move to the inversions, the redomiciled firms, the treatment of debt, so the treatment of the return, both in Ireland and the US, and the relationship between the parent company and its affiliates. Then in the double Irish and the statelessness, the jurisdiction was crucial because the key to the double Irish was that all the profits would end up in Bermuda, um, and therefore not be taxable. And the statelessness, the profits were nowhere. They were at a place of no address, which is no tax jurisdiction. And then so that showed that, the jurisdiction and the owner are probably important. And I would say in the current game around intellectual property, it's really the treatment of the return, this dimension, the treatment, the rule that allows um, tax write-offs in relation to the transfer of intellectual property. So the point here is not to know all this like detail within the games, but to show that because there's four dimensions to play with, states and companies can adjust their behavior when one game shuts down and open up a new one. And the classic example here is the double Irish and the statelessness one, which are similar games. They were shut down, but those companies very easily moved to the onshoring model. And some of them onshored their IP to Ireland, some went back to the US. Okay, next slide, Thomas. So this is the example of the double Irish to the onshoring, just to show you how it worked. So we don't need to know the detail of this because, though I would say power is in boring things, that is what I've learned through these studies. But basically what happened was the US developed its intellectual property. There were two companies set up in Ireland for the double Irish, where the huge profits of sales, for example, of Google and others, were booked. There was a company set up in Ireland, which through this particular rule allowed it to have a tax resident company in Bermuda, which held the IP license here. And the flow of income moved from an operational company in Ireland, which was actually making things, paying for royalty, paying royalty fees for the use of the license, so that any of the profits all ended up here, but flowed back to Bermuda, where there was no tax charge on the company. And the Netherlands is in here because in order to make a royalty payment from an Irish company to Bermuda, there would be normally be a withholding tax charge on the company. But because they set up a company in the Netherlands and let the money flow through the Netherlands had a particular relationship with Bermuda, which allowed a putting aside of a withholding tax charge. Okay. So basically, though, the bottom line in all of these corporate complexities is that the real work for this company happened in the US. All the thinking about the intellectual property, it occurred there. And the profits ended up in Bermuda.
Sorry,
Okay.
in this particular one, what would benefit to Ireland tax-wise? Very little, was it?
Very little, though there was an operational company which probably did it shifted probably most of its profits to Bermuda because they were in the form of payments for royalty fees for use of the license. But it probably had other profits. It was it was actually making things. So, and it would have also contributed, income, to other tax payments through being an employer in Ireland.
Yeah,
Yeah,
and if it's just job we deal with it.
absolutely, all of that. Yeah. Okay. All right. Great. So we go to the next slide, Thomas. So yeah, you can keep going. But basically, once the Irish government came under pressure around the double Irish, from the US, from Europe, from its own population, it changed its tax residency rules, which did not allow this arrangement of having an Irish company which would not be tax resident, and that could have a tax resident company within Bermuda, which is the Irish company. Okay, bizarre. This is a colonial hangover. Actually, it's from British law, but even the British had stopped having that breed. So that's a story in and of itself. So basically, once this was not a runner legally, because the key to Ireland's tax games is they're largely legal. They're within the law, and despite the immorality of it. So then that meant ditch this, okay? But we still have the US company developing an IP, sales being booked in Ireland, and then the IP being transferred to Ireland due to this rule that was in place since 2009. And, a good few years beforehand, the government had thought about how will we handle intellectual property, which gives this huge tax break to companies to onshore it. So you saw, especially with the Apple case, that when Apple had a structure like this, but instead of Bermuda, it was nowhere. Okay, that's the stateless structure. And basically, it shifted from that straight into the onshoring model. And you might remember like the leprechaun economics headlines because it caused a 15%, no, a 26% jump in Ireland's GDP.
Unless a
Yeah.
hundred rules change this.
Yeah. So the change, Ireland simply changed its tax residency rules to say that no company cannot be tax resident in Ireland. So you have to be tax resident if you're a company in Ireland.
But why
So
did Ireland do that?
because of political pressure, which
From within Europe.
from outside Ireland for sure, Europe and the US. Yeah, great question. Okay, next. Yeah. So the point that I wanted to make here about those last slides is the double Irish and the statelessness could not have been built without a coming together of US and Irish tax rules. They were like in symbiosis and in totality facilitated the creation of these kind of structures. Now, I know we're only talking about like one company, Apple, but the magnitude of tax avoidance was massive, as we know. The double Irish was a really important structure used by a lot of large companies via Ireland. So they weren't just kind of side show sort of things. So you can see all of the different types of rules, Ireland's tax treaties. It's part of the EU Royalties Directive, which meant there was no payment shifting due from companies when they shifted profits, royalty payments from Ireland to the Netherlands, for example. The residency rules and their interaction with the US, because the US and Ireland had contrasting residency rules, which allowed Apple to be resident nowhere because they're measured in different ways in both jurisdictions. A plethora of US tax rules, which enabled, which meant that the IRS in the US disregarded certain transactions throughout the flow of finance in those structures. And then Alex has mentioned, the new US rules, which are now the old US rules under Trump 1, 2017. New rules had been introduced, these alphabet soup here, we don't need to go into it, but they're basically a mixture of carrots and sticks to get US companies to onshore and to stop them from engaging in aggressive tax avoidance. As Alex has said, they didn't really work anyway, but they did have an impact certainly on once the double Irish ended and once these 2017 US rules came through, companies made new decisions about where they were placing their intellectual property. So Ireland won part of the tax games on that. The US won some went to other places in Europe and to Asia. Okay, so we can continue there.
Can I ask a question? Yes.
Yeah.
The tax rules within each country, are they made by a Department of Finance in each country? How are they implemented? Are they
Yeah, yeah.
do they have
It's a great question because in effect, what happens, what's meant to happen is the government, the Department of Finance say, this is what we want to do with tax policy. These are the outcomes we want. Then they publish the revenue commissioners or whoever the tax authority is and say, technically, how can we do that? Now, in practice, of course, well, anyone I've ever talked to in revenue said, we don't make policy. We don't do that. And that they do what they're told, and in many cases that's true. But the absolutely the Department of Finance, and in Ireland the Department of the Taoiseach, I would say, on this as well, is who directs what happens. But there are then the other actors who give them ideas and know-how. Okay, and that's the sort of the tax planning Irish government nexus where they develop tax policy almost in tandem. Okay. So counter movements against the tax games, and this is about like thinking about how this ends. There's been three major effective attacks on Ireland's tax games. Effective in the sense that it made Ireland change the rules in relation to one of the four dimensions of tax. So the first one was the EC saying, nope, you cannot have a 0% tax rate or a 10% manufacturing rate. That's state aid within the European Union. So how did the Irish government respond to this? They said, okay, we will increase the tax rate to 12.5, which was, viewed as extremely low by the European Commission, number one. And number two, we applied to all companies within the state. So many people in Ireland, in official Ireland, believe the European Union never really forgave Ireland for pulling such a fast one. And they also didn't believe that it would work for Ireland. They didn't think it was possible to collect adequate revenues from such a low rate. The second challenge was in relation to the Apple case, the coming out of the double Irish in the media, um, particularly the US Senate holding a hearing on Apple, and the European Commission then subsequently deciding to take a state aid challenge against Apple. But what did the Irish state do then? No, it didn't completely do a root and branch reform of its tax code. Instead, it changed its tax residency rules. Okay, so it was seen to take action to close down these things. But as I've shown you in the other slides, a new game was automatically ready and open for these tech and pharma companies through the onshoring of intellectual property. And then the third counter movement was through the OECD tax politics, that whatever about how weak the OECD is, it put pressure, and the US put a certain amount of pressure on Ireland to adopt the global minimum tax. And Ireland eventually, capitulated and agreed to this really low 15% rate by dragging it out in its usual way of always showing it's on the side of corporate America, but it's sort of doing the politics of it and making an agreement at the last minute. But this had absolutely no effect on the existing tax game, which was the onshoring of intellectual property. It didn't intervene in the ongoing game, and the treatment of intellectual property just doesn't seem to have been dealt with in that OECD process. Okay, Thomas, you can go to the next one. So the main findings then from this are each tax game I found was very distinct. It used the tax dimensions in different ways, especially with tech and pharma who were challenged on some of the games. There was a new game ready once one came to an end. And this was both a mixture of the government kind of market intelligence, looking ahead, going, okay, intellectual property is the next big thing. We need a regime for that, blah, blah, blah. And then the corporations, making use of what was there. The Irish state also at times lost control. I believe that the period of inversions, the flipped headquarters like Shire Pharma and Medtronic and all of those, that was a big embarrassment for the Irish state. It was all over the US press. But in a sense, they couldn't control it because Ireland's rules were what they were. So I think this is an important point that corporations really can push the boundaries of things when they wish. The counter movements to the games, they did result in changes, but only changes to new games. Okay, and they all arose as external threats. So this is not to be discouraging because I think the domestic tax justice movement is really important, but it shows where the pressure actually had a certain amount of an effect. I don't see this as an Irish tax haven problem. I see it as a US Ireland onshore offshore world. Okay, so they are entangled, and that is critical to how it works. So I absolutely agree that how the games could be ended is the US could end the games. The US could just introduce legislation that makes a lot of these things impossible. Neither side of the aisle in the US has come close to doing that. It's like threatening to come close. Biden saying we're going to tax multinationals more. We're going to bring them back and tax them more in the US, which he didn't do in the end. And Trump saying we're going to bring them back. He's not saying he's going to tax them more because they're like his mates as well. But what he might do, which would be the threat to the games, is tax them just a little bit less than we're doing in Ireland. And then that would make the US way more attractive than Ireland. The only caveat I would say to that is because there's so much intellectual property in Ireland, my understanding is that the tax centres within these companies don't move intellectual property lightly. So I'm not convinced that the IP games will end as quickly as expect. I just don't know. I mean, this is the constant conversation. They're going to end. They're going to end. But the lesson from that I've learned from my study is they are stable. They're pretty stable. Yeah.
So just
But the US could end it.
but
Yeah.
by intellectual property there, do you mean
Yeah.
people or data?
A license
That's
for
what the
intellectual
actual license.
property. Yes, license
So what
for use.
why is there a problem with moving that?
Just because they're really valuable. So even if they were moved out of Ireland, there would be a cost, a transaction cost to move it back, whether it's to the US or to another country. So it would be a costly thing to do. And secondly, there's other considerations like where do you actually want your most valuable asset of your conglomerate to be? Yeah. And Ireland couldn't have played the tax games better because the norms in global tax, which tax planners are always going on about, are saying, oh, they've shifted now. It's substance. You have to have economic substance in a place in order to put your profits there. And Ireland is the perfect example of low tax with real substance. So it is, it is in a sense come full circle in the games. And the other thing I would just flag is that it's the combined corporate institutional power in US and Irish tax politics that drives the tax games. So when we're strategizing, we need to be thinking in those terms of these two complex forms of tax politics that work in different ways, but that in their interaction is really important. But it's very difficult to disrupt that kind of power. So I think I just have one or two. Have I a minute or two, Thomas? Just on Cumhale? Yeah, and Michael. Yeah.
Um, so it sounds to me the crux of the question that the UN tax convention is taxing fairly based on economic activity
Mm,
is a quite philosophical question in many respects because at the moment intellectual property in the piece of paper,
Yeah.
wherever you legally register that is, the system says that's where the economic activity happens. But
mhm,
intellectual property, this is philosophically, it's partly the guys who think this up, but
Mm.
because so much intellectual property is done by data of the public to do its sales,
mhm.
the intellectual property is
Yeah.
also linked to where it's being sold.
Yeah.
Is that going to be a key debate for the UN tax convention? Because that seems to be, to me,
Mm.
the key thing. When we say where economic activity happens,
Yeah.
the answer is, well, it happens in Ireland because legally that's where the asset
Yeah.
is it registered.
Yeah. Yeah.
But
And
in reality,
Yeah.
the developer of the intellectual property is dispersed around the world.
Yeah, absolutely. Yeah.
Is that going to happen? Is that the real battleground?
Yeah, I mean, Alex will be able to comment more on that than me, I think. But in terms of profit allocation rules, the advocacy work around that from TJN and others has been around formulae focused on sales and where sales happen, assets are, and employees are based. It also raises other interesting issues like the US is always going to win if assets are privileged, because they're doing all this R&D work, which was largely funded by the US industrial military complex and then taken by US corporations. So there's a huge debate there. But I'm just actually going to kind of follow on to that a little bit. So where are we now? We're in Trump 2. He's still protecting US multinational companies, as Alex has said. He's pulled out of the multilateral approach to tax reform. So basically, what it seems to me, and I haven't really kept up with it lately, but the global tax, the minimum tax is still there, which is a very weak reform, but it's unprecedented. It's only for non-US parented companies, which is, totally excludes those companies. And US companies will be dealt with through the US tax code then. And this is bad because Trump's, one big beautiful bill has doubled down on tax breaks for multinational corporations. It gotten stricter in some ways, but overall, I would say, is committed to a low tax of those companies. So Ireland, if you look at the latest budget, is really emphasizing how it's going to treat cross-border transactions, how it's going to treat interest payments, and expanding the research and development tax credit really massively from 30 to 35%, which was even more, I think, than IBEC, the business association, were asking for, and also giving tax credits to certain sectors like digital gaming and stuff like that. So are the IP games, will they end or not? I don't know. I don't think they will end as quickly as some suspect, to be honest. But Ireland is now looking to these areas, financial services, and giving very lenient definitions of research and development, where you'll have companies, hosting huge expenses for R&D in Ireland, I think. And then just the next part. So tax power, very difficult to disrupt the games because of this enmeshed politics. I think the key focus has to be Ireland break dependency on foreign direct investment. Now, I would like to flag, and I'm really pleased about this, that a colleague of mine in Maynooth University is working with the Nevin Economic Institute on charting out an alternative industrial model for Ireland. And that requires a robust critique of the corporate tax regime. Implementation of more robust tax rule reforms, they absolutely should be UN-led. But one thing that I wanted to ask you, Alex, about is what about pressure for a harmonised tax system within the EU, which is kind of a dead political project. But that to me seems the answer to ending the Irish tax games. And the Irish government won't want to do any of that. Okay. When it's challenged, it continues the model. It has no investment in developing a replacement for the FDI centered industrial policy of the state. And there are, whatever, 150,000 jobs depending on that. So what it needs is long-term thinking around a political alliance, I believe, between Labour and global justice groups within Ireland, because I don't think we can make a case for ending Ireland's industrial policy without the trade unions. Although they have supported the model in the past, they don't anymore, is my view. And tax reform minded states. So, whatever alliances there can be through the UN process, I think is the way forward. So, they're call slides. Oh yeah, sorry. Do I have time for one more minute, Thomas? Just
As quickly as
yeah. So just on campaigning on tax previously, like I'm way out of it now, but I was very involved in this after the financial crash. And just to say, at that time, talking about corporate tax in Ireland was like a no go. It was an untouchable issue. You remember some of you were involved probably in the report Driving the Getaway Car, Ireland Tax and Development. The Department of Finance went ballistic when we published that. There was threats to our funding. They were ringing up Irish Aid and the Department of Foreign Affairs saying, why are you funding this organization? Da, da, da. There was a lot of pressure brought on anybody who spoke out against the corporate tax regime. But this has changed. The Irish government, the cat is out of the bag. It has been reputationally damaged all around the world. It will try to, not engage, but I think it is now a legitimate area of debate, which is a great opportunity. The trade union movement also knows this and knows it needs to adopt a more proactive position. And in terms of north-south stuff, I think the tax sovereignty thing is interesting. Like I liked your definition of it, Alex, when you kicked off your presentation about the people feeling the tax system works for them. But in a sense, Ireland has used tax sovereignty as a way to just do its own thing and ignore pressure from the European Union. So talking about, I can't really see how we can get over the tax games without a common harmonized tax base with it, consolidated tax base within the European Union, because you saw all the dimensions of corporate tax, how they can reform to make new tax games. The rules need to be simple and uniform, and that makes it much harder for companies to invent a game. And then on just the global north-south alliances, in FJI, we always kind of did insider outsider stuff. And the key thing with the insider stuff is that Global South comrades knew why we were doing it, that we had a strategy of engagement, but also one that was critical of, yeah, how those things usually work out. So that's it, I think. Yeah.